I'm going to take these two, it looks like, side by side because they're related. So S, this just says S. S says, how do I stop out a put credit spread? I've had a few spreads run away from me when I don't have access to trading. Okay, let's see, who was down good today on my notes? Kraft was pretty good, mentioning that as a bull put credit spread. Gilead was down 92, not too bad. All right, let's go to the custom spread tool. And let's say that on Gilead, I had entered a spread for next week's expiration, bull put credit spread, and I'd sold the 75 and bought the 73, do a 2-point spread. And let's say I did this when the stock was up at about $77 or so for 6 weeks out, or 6 days out. I apologize. All right. So we would have sold this and bought this, and just keep one contract for the math simple. Let's say we did a 50, 28 spread here. So about 22 cents of net credit on a 2-point spread. Good return of 12.4%. Okay, now this one's already below S. I understand that. And we'll take a look at what the loss is in just a moment. Okay, so when I enter, we did a brief review on this recently. And we reviewed what we call the 8 ways to manage a bull put credit spread. But here's the trick. Number one, the first and important thing to do, I feel, is if you don't have access to trading, you might want to make sure you're not doing volatile stocks. As Sam mentioned earlier with the bull puts he was discussing, the 2 spreads he discussed, he said that look for a quality stock that doesn't have a lot of volatility even when the market's going. He suggested Apple and Microsoft and so forth. In any case, we're saying that the stock was maybe up above 77 when I did this position. And when I enter a bull put credit spread, it's usually because it matched certain things. I would have looked for a stock that was trading above a 20-day or 50-day moving average, most likely the 20. I might have looked for a positive MACD at least 3 or 4 days with a positive crossover. And I might have looked for other details as well, probability / delta, depending on which one you prefer. I prefer probability, likely would have been 85% or more. So I've entered the trade. What am I going to do now? I'm going to set triggers in my portfolio and power options and likely my broker to notify me if the stock reaches within 1% of my short put strike price. So I'm at a 75, so if the stock dropped down to about 75 or so, I'm getting nervous. Okay, it's not to close the position S, it's more of a mental alert to say, hey, this isn't going the direction you want, something's happening, let's take a look more in depth into this stock. Is there any news out there that might cause me hesitation or anything along those lines? Also, whatever criteria that you use to get into the position, if you look for a stock to be trading above a 20-day moving average, well, you might want to set an alert if the stock falls below that moving average, if the direction changes, or if the MACD crossover starts to turn negative, right? If the MACD now crosses below the signal line, you might want to consider getting out of the position. If in one day, which does happen to these positions, you wake up in the morning and the stock hits your 1%, has dropped below the 20-day SMA, and has a negative MACD crossover, that's probably a good signal to get out of the position. Okay, but if you use delta and you got in when the short put was a delta of 0.2, you may want to use a stop if the short delta doubles. Let's say it goes to 0.4, which would be right around here if the stock reaches within that 1% rule as it starts to decline. So the first things first, make sure you set your triggers correctly. If you can't watch it all the time because you don't have access to your trading, get an alert and then you know what to do. Okay, so it's typically what I call the pivot option in my education and discussions, the option that you sold. That's the most important. Quick review, 8 ways to manage a bull put credit spread once the stock starts to move against you. Typically, you don't want to let it go below the short put strike price. That's why that 1% rule is in there. Number 1, of course, is what? Do nothing. Maybe it was just a market pullback like we saw in the last few days. We think it's going to recover in the next week or in the next 4 or 5 days. So we're just going to leave it alone and hope it moves back up. All right? Number 2, if those triggers are hit, close the spread, take the loss, and move on. No one really wants to do that, but sometimes it's more beneficial. We took in a 22-cent net credit, which means we have a true risk of 178 on this position. What I look for is 50% of the maximum loss. If the stock starts to fall, the option price is change, excuse me, and I've hit half of that, so what would that be, 89 cents? Yeah. Yes, so if my liquidation to buy to close the short and sell to close the long is half of the maximum loss if the stock starts to move against me, now that includes the net credit. So I'm not saying I would close it at 89 cents liquidation, be the 89 cents plus the 22 because I'm keeping this 22 cents regardless, right? So that's what I'm looking for in that case. But I can't let the spread go more than a 50% loss on the position. I'll turn it off before it gets to 60, 70, or 80%. Okay? Number 3, the common one that you know about is to just close the spread, liquidate this spread, buy to close the short, sell to close the long, and then roll down and out in time. So this is a 6-day trade. The stock starts to move against me. It's below my strike prices. We're trading at 74.57 now. I might close this spread, but then have to go out to maybe August or more to maybe roll to a 73.71 bull put credit spread that's down. Now, I'm not saying it's going to be a loss, but it's going to be the lower strike prices here. I'm going to have to likely go out to August to try to make back whatever loss I took. The other problem that you have with this position, this adjustment of rolling just down and out, there's 3 problems in my opinion. Number 1, August is nice. August is being generous. You're probably going out to September to make back the loss you took on this position. Or maybe October. What does that mean? You're going 2 to 3 months out in time on a stock that's moving against your desired expectation. People say don't try to catch the falling knife or stand the way in the freight train. That's one of the reasons I'm not a big fan of just this common adjustment. Another thought that I don't really like doing it this way, this number 3, just closing it and rolling down, is I'm normally going to have to increase the strike prices or increase the number of contracts in order to make back this loss I took of 89 cents. This 1 week, 2 week out spread was 22 cents. I roll out a month, I might only be getting 40 cents. I go out 2 months, I might only be getting 50 cents on my 2-point spread, which sounds nice, but again, that's 60 days. I might have to go to a 4-point spread, a 5-point spread in order to get this premium back. Or double or triple the contract size, which means what? Much larger risk trading a bullish position as the stock continues to move against you, or the stock is moving against you. So that's some of the caveats with number 3. Number 4, of course, similar to that. These might be a little bit out of order from how I normally teach them, but going in this order, number 4, of course, we could just close the spread as we did in 2 and 3 and open the opposite. I entered a bull put credit spread. Stock is moving against me. I'm going to try to stay in and manage this position against this stock so it looks like a winner in my portfolio. Close the bull put spread for the loss and now open a bear call spread. But to get back the loss, what are you going to have to do? Increase the strike prices, which increases the risk, or increase the number of contracts, which increases the number of risk. But now in a stock that's showing you a bearish trend, you're in a bear call or bear put debit spread, which is much better. Number 5, sometimes works, sometimes doesn't work. You have to have a really bearish expectation. If you still have time S, and by time I mean 10 days to expiration, 14 days or more, and the stock has fallen near your triggers and your short put strike price, it's a big hit up front, but what you could just do is close the short only. Buy to close the short and leave the long open. What does that do? That puts you in a long put position where the cost is your buyback cost from the short minus the 22-cent net credit. So anywhere below that break even, if it continues to fall, you're in the profit zone. Close the short, leave the long open. Now I'm kind of missing one here. I can tell already. We did close and do the opposite. Number 6, if the stock has fallen a little bit and you think it's going to stabilize and recover, what some investors will do is trade a bear call spread. Not closing it and doing the opposite, will trade a bear call spread on the position to create an iron condor. One of the things I don't particularly like about this idea, or some will do a butterfly, some kind of butterfly combination, convert the bull put credit spread to a condor or a butterfly. But one of the reasons I don't like this is it's going to increase your premium, which means it's going to give you a better lower break-even and also an upper break-even. But it didn't address the bull put spread that's still losing. If it continues to fall, you could still lose more on this bull put credit spread. You didn't address the issue there in that case. So the iron condor can be very useful to increase premium and increase your break-evens, but you didn't address the one side or the other. Okay, so there's that. 7, we did close and roll down, close and do the opposite. Close the short only. I'm missing one for some reason. That's okay, because usually what number 8 is called the pendulum adjustment. So let me go through this again. Stocks falls, hits your triggers, it's being threatened. 1, do nothing, hope it recovers. 2, close it, move on, make your money back on another stock that's showing a better trend. 3, close the position, roll down and out in strikes, and you might have to increase the strikes as well. 4, close and do the opposite. So you do a bear call credit spread following the trend. 5, close the short put only, leave the long open. Number 6, convert it to an iron condor by trading the bear call credit spread in this case. And usually what ends up being number 8 is what's called the pendulum adjustment. And the pendulum adjustment's neat because that might work in this scenario. And what the pendulum adjustment is, when the stock just suddenly falls below my short put strike price, I may convert this to a bearish position with one option move instead of closing 2. I may buy to close that long 73 of the bull put and buy a 77. So with one move, I've taken the bull put credit spread into a bear put debit spread on a stock that's falling against me. That's called the pendulum adjustment. There's only 6 days to expiration on this example. I don't think it would work. I don't think we have enough premium, but let's try it. Go out to July 2nd. Oh, quick interlude. Everyone remember, markets close next week, Friday, July 3rd. We probably won't be here on a webinar in honor of Independence Day. Your expiration next week is actually Thursday. You need to make your changes by Thursday of next week, not by Friday, okay? All right, so 73 there, 77 there. I'm going to sell to close my long put, and I'm going to buy to open. God, these prices are weird. Sorry about that. Buy to open the 77. Okay? So with one swing, oh, good. What did I just do? With just one movement, I entered now a bear put debit spread for a total cost of only 184 on a 2-point spread, which means I can still get a small return of 4.2% if the market continues down or stays below 75 now. I know it's playing it close to the vest, but that's the pendulum adjustment. We took our initial bull put here, moved this leg out, gave us a profitable return on the position. So we turned a loser into a winner by moving one option. That's the pendulum adjustment. Oh, sorry, folks. Really typically only works when the stock is falling below that initial short put strike price, not before. The best moneyness is when it's between the two strike prices to swing the long one out as well. Okay, so that's a quick review of those. Let me just see what this is here. Let me put this into June 19th webinar. Okay. Oops. I'm sorry. I was just going to look at something real quick. I'll do it. I'll just do it here. Okay. So anyway, what I was going to do is just see where the liquidation value is now. Remember, we took in that 22 cents initial net credit. Thought it cleared those out. I didn't resubmit. All right. Well, in any case, we can see real quick what the loss would be. Remember, we got 22 cents, and it would cost us about $1.50 here, and we get 50 cents. So it's almost at $1.98 to close the position right now. But by doing the conversion to the bear put debit, we could take a loss of almost a little bit above 50% that we have on this bull put spread now, convert it to a bear put debit on a stock that's declining, and be in a profitable position. Okay. For future reference and for more detailed reference, now that we've reviewed that, spent about 10 minutes on the review there for you. At any time, remember, you can go to the webinars page. This is a public page, powerup.com/webinars.asp. I'll send it out in the chat window to everyone. There we go. And if you go into the options strategy section, okay, now if you're on a trial, the most recent 5 webinars are not available. Those ones that have posted from February till now, as a subscriber, those will be open. But you still have about 20 or 30 different webinars you can access from the past. And here we go, from 9/19/2018, the full presentation on 8 ways to manage a bull put credit spread, including the trigger points we talked about and what we want to look for in that case and more. Okay, so that's what's available for you there. powerup.com/webinars.asp, scroll down, and then you also see other managements here. There's managements on covered calls, managing naked put positions, bear call spreads, for example, and more. Okay, so I'll give you a better reference point in that case. All right, John, I believe you're up next, but before I get to your question, which goes along a little bit with bull put credit spreads, we're just going to scroll down here. I was waiting for this comment from Sam, and it was sort of what I alluded at to. Sam says, I feel if you cannot watch the market, then don't go with the weeklies. That's good advice. I mean, maybe not even the 2-week spread. You might want to do monthly so you can go further out of the money with similar probability. Have that there as well in that case. So the weeklies move very quick, and you can't really go as far out of the money as you would like to. In some cases, when there's a sudden market turn like we saw 2 weeks ago, then when we saw last couple days, it might not be a good idea to use the weeklies. You might want to go to the monthly to allow yourself to be further out of the money with still a good return and a good probability. And that says, thanks, I'll review the 8 ways to manage and put in some better alarms to get my attention, so I might not have to deal with these decisions. Well, you will. Okay, even with my preferred strategy in bull puts and the criteria that I use, as I mentioned, they're 2 weeks out in time and an 85% probability, I'm still right an average of 83–84% of the time. That does mean that I face management or just closing the positions 16 to 17% of the time. Okay, all right. Real quick, while it's here and I see it, William asked about 10 minutes ago, he says, Mike, hello Michael, regarding the TQQQ covered call strategy, because it's a 3 times ETF, then how would you defend it if the position moves sharply down? I answered the question about, oh yeah, and I mean, I did mention that, I think, but you said, what about you, Pro, same as TQQQ? Yes, absolutely. Focus on the downside protection and the return that match your goals, not so much the delta. Okay, you'll see as you start to see which option gives you the downside protection you want and the return that you want for your approach, whether you want to be in the money or out of the money, you'll start seeing deltas being in the same range. If you want to be out of the money, it's probably going to be between 0.4 to 0.3. If you want to be in the money, like we said, it was probably going to be between that 0.65 to maybe that 0.75 or 0.8 range with the delta. But yes, look at the chain. Based on the option chain, based on the downside protection that's available as well. See what's there. And for William, related to how you protect it, I didn't want to mention this because Amin was just asking about covered calls. But if I were to do a 2 or 3 times ETF position, I'd probably be opening it as a long collar, meaning I'm selling the at or just out of the money 1 week out, 2 week out call, buying a put that's maybe 2 or 3 strikes below it, trying to get into an area where I could still make 2 to 3% if I'm right to the upside, but controlling the risk to a guarantee of no further loss than hopefully with the higher volatility, it'd probably be 7 or 8% if it moves against me. Now, if you are in a covered call position that moves against you, whether it's a 3 times ETF that William was worried about here about protection, we talk about rolling down, but this one could quickly go, as William mentioned, to a large percentage loss of the capital because it is a 3 times ETF. Even though the volatility looks good, the stock can fluctuate drastically. Same idea here. Going into the options concepts section, here's that webinar from 2016, Manage a Broken Position. It's always a good one to check out. Alternative methods for managing a stock position that has fallen in price, a covered call position that has moved against you, managing a naked put that's now in the money and the stock has been put to you, and conversations on bullish spread positions. This gives some ideas about not not just rolling down the call and trying to catch that falling knife, but other ways you may look to stop the bleeding using the stock repair tool to help you get back to break even faster. That's also a really strong presentation to review at any time when you're looking at covered calls, naked puts, or trying to think about repairing a broken position. Okay? All right. Now, okay, so that's for William's question, and I want to get up to John here for the probability. John, I'm sorry, JB. Does the probability above calculation, talking about bull put credit spreads or anything, covered calls, the probability of being assigned or the probability of expiring worthless, but he says, does the probability above calculation incorporate the level of volatility and or implied volatility? And the answer, of course, is yes. So here's Spotify at 264.95. We've got an 87% probability 14 days out with a 227, 225. Here's Zoom Video at 256. They're almost similar prices, aren't they? I mean, this is a decent example just by chance. These are pretty close in price, but yeah, they're 5 points off. So what does that mean? Look here. We can go down to the 222.5 and have the same 87% probability. Is it because the numbers are different? A little bit, but they're not that far off. Let's take a look here. I'm sorry, research, and I want to go to stock research. The volatility, let's just use the 20-day volatility on Spotify is 0.65. On Zoom Video, 20-day volatility is 0.69. Okay, so what does this mean? Well, take a look at it. Similar price stocks, 264, 256. I know they're different. We can go 5 points lower and have the same probability, essentially. And one of the reasons why is this has that higher volatility, which also means a higher premium, but at the same time does that as well. The volatility, the underlying stock volatility, is typically the main flux of the probability equation. Okay? I'm trying to think of two good examples. Square and Etsy, they're probably about the same volatility. You know, if you look at some cheaper stocks, if you look at Ford, for example, okay, and I think I'm going to go to the chain on Ford. We'll just take a look at the call chain here. We'll go 2 weeks out in time to the 10th, sorry. Okay, all right. So stock is at 591. And, okay, so let's call it $6. The 5 strike is what I wanted. Has a probability above of 70%. And an IV of 0.70. That doesn't mean they're the same, but it's an applied volatility of 0.70, and the stock volatility, oh, I'm sorry, no, it's 0.84. I apologize. IV of 0.84, oh yeah, 88.9% probability is going to be above 5. Now, if you found another stock, a $6 stock here, with a lower volatility, the 550 strike might have a 75% probability above, not the 5. And why is that? And it's because it has a lower volatility, so there's less likelihood of expected fluctuation down to the 550 or even the 5 strike. Whereas Ford is relatively high in that case, so even though we'd say 88.9% is high, we might have a 75 or 80% at the 550 strike on a stock with the lower volatility. It is taken into account in that case. And a lot of times we also might use what's called the SIV for some of the calculations of probability for the near-term options. The SIV is the average of the in-the-money and out-of-the-money implied volatility of calls and puts. It's not frequently used, but the volatility is a factor there, JB, that is taken into account with the probability equation. Okay. All right. Now, on that note, let's see here. Craig, your question is going to be next after this one, but we were talking about, I'm sorry, bull put credit spreads. So I should have gone back to the search. And we were talking about the probability in that case, but for anything, an out-of-the-money covered call, in-the-money covered call, and so forth. Okay, and so let's see here. This is from Rhabib, and he said, for weekly credit spreads expiring in less than 10 days, what criteria should I use, and what should be my exit criteria? We already talked about bull put spreads, didn't we? This is the criteria that I use for my bull put spreads, weekly bull puts. As I mentioned, in a discussion before I even read your question, Rhabib, in my testing, I found that going 2 weeks out over different market conditions yielded a better return for me than trying to look for a higher probability, 80 to 85% probability, doing a 5-day or 4-day out spread. I'd have to take a lower probability to get a better return. But comparing the two probabilities, I was more successful with the 2-week out potential than the 1 week out. Okay? Not to say there's wrong with weeklies, it's just the criteria that I preferred, that I wanted, which is shown right here. Minimum 20-cent net credit, 9% return, 3% out of the money, 85% probability. And by the way, I did find that dollar strike and 50-cent strike differences did not work as well as using strikes that were 2, 2.5, and 5 points apart. I found that this actually, even though you say, oh, well, it's less capital if we only use 1 point, well, all of the testing and all of my trading that I did with this in conjunction with the back testing while I was real trading them as well, everything showed that it was just better to use the higher strike differences and get a little bit higher net credit. But it was also based on, I was only allocating, let's say, 10% of my total portfolio. I was going to only open 3 positions. So if it did 1 point spreads, it'd still be the same monetary allocation for the trading plan. It wouldn't change. I wouldn't be using half the money. Okay, I'd still be using 10% of my portfolio, and I'd be using 3 trades, or maybe I'd double it to 6 trades, but the same almost monetary allocation would be into each one, and this performed better. I talked about some of the other things. Stock above the SMA 20, positive MACD crossover in any credit spread, monthly, weekly. Avoid earnings between now and expiration. Okay, it's as simple as that. So this is my starting point. This is what I look for, and on the bear call credits, Rhabib, it'd be very similar, except for I'd be looking for stocks below the 20-day moving average that had a MACD crossover for at least the last 2 to 3 days, and of course, avoiding earnings between now and expiration. Things can change on a dime, and that was Sam's warning earlier in relation to the weekly, the discussion we were having about the spreads, that for S, if you can't watch it that consistently, you might want to go to the monthly. Because you have to go closer to the price. You have to go closer to the vest. And yes, you still have a 75-80% probability. But something like 2 Thursdays ago, with the Dow dropping 1,600 points, 1,800 points, something we've seen in the last 3 days. What was a winning trade on Tuesday is likely a losing trade by Thursday. It might be a 75-80% loss today. But you still want to follow the rules. Don't look for the spread with the highest return. Look for the stock that's going in the desired direction that you want to match the sentiment if you're going bullish or bearish. And then look for the probability and return and time frame that suits your goals and expectations. I prefer probabilities of greater than 80 to 85%, whether I'm looking 1 week out, 2 weeks out, or a month out. And yes, I've tested that extensively against, isn't it better to take a 70% probability and see 30% returns? Oh, in this case, volatility is thrown out. The average is usually around here, 16, 17, 15, 14% returns. But usually if I go to a 70% probability, 75%, everything is a 32, 33, 34% return. You say, how can you go wrong? Well, you can, because now you're too close to the stock price, and with markets that we've seen in the past 2 years, you're getting pulled out of those positions because it hit your triggers, the 1% rule, fell below the 20-day moving average, had a negative MACD crossover. If you're using delta, it changed the delta. So you're getting closed out of positions much more often on those that aren't going into profits ever to close the position early, and you don't make it up, okay? And even at 75 to 80%, I found that you actually need to be right 80 to 82% of the time in order to stay successful long term, okay? But with the 85% probabilities are higher, it's much easier to see a constant return as well.